I do think that's going to happen in the metals again. They're more diversified, especially silver, because it's in more hands worldwide, and it's small hands, retail investors.
Welcome to this captivating discussion with David Morgan, a renowned expert in the precious metals market, as he shares insights on the silver market and why it can be a goldmine for patient investors. Join us as he unravels the secrets of successful silver investing, revealing compelling reasons for his optimistic outlook. Don't miss out on this opportunity to gain valuable knowledge from one of the industry's most respected voices. Tune in now and be part of this insightful conversation.
And he said 90% of the move comes in the last 10% of the time in the silver market. And that caught my attention. Of course, I knew what he was talking about. So I went home and I did the arithmetic.
Yeah.
And I found out that, during the Hunt situation in the late 70s, 1980, that if you were a patient investor and you bought silver in 1965 when it was taken out of circulation at $1.29 an ounce, and you waited until January 1979, you hit an all-time high of $6 an ounce. But if you were a rank speculator, you didn't know any better, you got in at $6 an ounce in January 79, and you waited 1 year, it went from $6 to $50. So you had over an 800% increase in 1 year. So if you do the arithmetic, what you find out is that move from 6 to 50 is about 90% of the move. And if you look at it from 1965 to 1980, it was in about 7% of the time. So the rough numbers. Now, just because that's what happened in the past doesn't guarantee it'll happen in the future. But what I do know in all markets is that the final leg, the Elliott wave guys would call it the third leg up.
Yeah.
It's usually double the second one. So the second leg up in silver was from around $9 to $50. So that was about a five-fold increase. So if you double 5, that's 10. So you go from the bottom this time, which was roughly 12 during the CV19 situation in March 2020. And it was a spike 12. I don't count it, but I'll use it as the low. So 12 times 10 is 120. Now I've said back in 2003 in my first book that silver would be $100 an ounce, roughly speaking. I do expect triple-digit silver, and I still do. So the point, coming back, we're going to re-emphasize it, Danny, and that's that all markets get this big rush at the final run-up. It goes parabolic, and people just are fearful of missing out, and so they're paying high and higher and higher and highest until you run out of buyers, and then you get a sharp decline right away. I do think that's going to happen in the metals again, unless they are brought into the monetary system some way, but they're more diversified, especially silver, because it's in more hands worldwide, and it's small hands, retail investors. So it's possible that that might mitigate a sharp correction. And just be patient and wait for gold to break the all-time high, which is, I don't know the exact number, 2,067 or something like that. It would have to maintain that above that price for at least 3 days in a row. That's the Morgan rule. And then if it does do that on bigger than average volume, then you have about an 85% probability you're on your way. So now in the commodities markets, as you probably heard others tell you or talk about, old resistance becomes new support. So we have a resistance around 2,000. Once it breaks through to the new high and it settles above that, then that becomes support. So it's not going to go below 2,000 without a lot of work. So it's going to go from 2,000. And what most people don't know, and I learned this from Bill O'Neill when I took a course at Investors Business Daily from the master himself, Bill actually taught the course, is the reason you actually want to buy on a new high when it first starts as a new high is because if a stock goes from $5 to $50, how many new highs does it make? And the answer is a heck of a lot. Because when it goes, at 5 and it makes a new high at 6, everyone that owns it at 6 says, you know what, I'm making money, but I don't know how high is high, I'm going to hold on. So everyone's holding, so any new buy pushes the price up to 8. And now those people that owned it at 5 say, geez, $8, that's a pretty good profit, but how high is it going to go? I'm going to hold. So any new buying takes it up to 10. And on it goes until it exhausts. It's like throwing a ball into the air. It'll keep going up, but eventually it will hit equilibrium and start coming down. But there's nothing safer than actually buying at a new high, as long as you know where the new high starts, and then just follow it up with a stop. I mean, I did quite well in the run-up in silver in April, May 2011, and I called the top. I called the top for my subscribers, and then I said it publicly. And, you know, looking back with 2020 hindsight, I probably should have just bypassed the market for 10 years and come back in. But I didn't know the future, and I'm still a sound money advocate.
Wait, you know what? I'm happy you're bringing this fresh perspective, because that's what I repeatedly hear. I don't want to touch, you know, gold if it's, you know, at these levels. I don't want to touch silver at these levels. So that's a different perspective there, David.
Well, if I could go on, I'll give you another quick example.
Yeah,
this one was in Forbes magazine years ago, and it was a professional trader, and he wasn't doing too well this particular year, so he took a year off. He studied everything he had done and everything he'd done wrong, and he looked at all the markets, but he's a futures trader. So when silver came along, he was back in the market, and what he did was what's called take the middle. So what he did was he waited for that new high. And the new high for him when he got in was like $15 an ounce. And remember, 6 was an all-time high in 1979 after years. So 15, that's over double. He sounds like you're an idiot. You're buying high. Yeah, he was. He got in at 15, he got out at 35. He left some, he knew the momentum was still strong. He knew there was a lot of buying. He knew he could sell in the strength, which is one thing you better learn in the futures market. So he took out 15 to 35. So what's that, 20 bucks on a leverage with many, many contracts. And he told his wife, we're out. And she'd heard that many times, we're out, you know, out of the position. He goes, no, honey, you don't understand. We're out. We are done. We are retired. We're finished. We've got enough money for the rest of our lives. It's over, complete. So that's kind of a cool story, but it proves the point again of what I'm saying is once this thing goes parabolic, pay attention. And it's really tough to call the top. I will be helping my people. David Smith and I wrote a book called Second Chance, how to make and keep big money during the coming gold and silver tsunami, because when this thing runs, everybody and his brother-in-law is going to want to get in, and that's fine. And they're going to be getting in at higher and higher prices, but you've got to look at it. And the hardest part for me, Daniela, is do I tell people to sell precious metals for fiat? Do I really do that? You know, and that's going to be a tough call, because if the system collapses further or whatever's going on at the time, you certainly don't want to be on a pile of paper if it keeps depreciating. So I'll address that at the time. Right. I think the best thing to do is just take it, you know, a day at a time and see how it works out. But anyway, probably overemphasize, but very interesting. Just because you make an announcement, that doesn't mean much of anything. And that's basically what they're doing. They're going to announce that the BRICS are going to have a gold-backed currency. And it's possible, and it's probably probable at some point that they will. But it's very difficult to get those 5 different cultures to really work together. There's kind of like the Euro situation. I mean, the Germans have a lot different work ethic and vacation strategy and all that than, let's say, Greece does. And so you put them all together, it's rather difficult to stir the pot and mix it up and make it work. Euro, again, is an example. So here we've got Brazil, we've got India, we've got Russia, we've got China. If they make it convertible, where you can buy the BRICS currency and immediately exchange it for, you know, physical gold, then that will impact the market. And if the BRICS decide to peg the gold price higher than, let's say, what the COMEX or the LBMA has, that will cause an arbitrage situation, which people say, oh, gold's at 2,000 and they're pegging it at 2,200. So it'll immediately, almost immediately correct, because of the arbitrage like that in any market. Markets are very efficient, especially when it comes to arbitrage. So they could be setting a new price for gold in, you know, US dollar terms or yuan terms or ruble terms or whatever. I think that it's more hype than anything else at this point. I do like the fact that it proves one of my basic premises, and that is, at the end of all great inflations, that the free market comes to the fore and starts finding ways to mitigate the problem. And what have we seen? Well, we've seen a lot of crypto over the last decade, right? That's to mitigate the problem. That's to get out of the current situation. You got barter clubs, of course, you've got precious metals all the way along. And then you have individual counties that have their own dollars. Ithaca dollars comes to mind. You can look it up on the web, but this is where communities agree that they're just going to bow out of the system. These are small communities usually, but we're just going to make up our own receipts for labor, and we're going to pass them around our community, and this is how we're going to settle business in our small town. That's kind of a one-off because you couldn't do that on a national basis. But coming back, so there's countries that are banding together that's saying, hey, we've had enough of this U.S. dollar dominance. It's really based on nothing but hot air and politicians' rhetoric, and we're tired of giving you real goods and services for it, so we're going to start our own currency. So it's all shaping up to the fact that we're near the end game. Absolutely. I mean, Janet Yellen gave a speech recently that like 90% is done in dollars. That's BS. It's about half that amount. So as you just outlined, more and more countries are just settling between themselves and their own currencies. And that trend will continue. I mean, the dollar index right now is around 100. It was like 105 just back in March. So it's losing value on the Dixie, the dollar index, pretty rapidly. And I think the next threshold, I don't have all my charts in front of me, I think it's 92. And then if it reaches 92, then it's 70. And once it gets down to that level, and I think it will, there'll be more and more of a rush to settle outside of the U.S. dollar, settle in precious metals, settle in crypto, or what have you. So the dollar's days are numbered, but I also want to, and I'm trying not to contradict myself, but I'm a big believer in the Exeter Pyramid. I've talked about it. I'm not sure with you, but with others. And it's John Exeter. He worked for the Federal Reserve Bank in New York, long deceased, but he developed this upside-down pyramid, which is a good outline of how the monetary system or the financial system is actually structured. So at the base of the pyramid, or the tip of the pyramid, is gold. And anything, the higher up the pyramid you go, more to the base. Remember, it's an upside-down pyramid, the more risk you have. Well, back when he made his model, derivatives were really non-existent. And now we've got something like in the 1 or 2 quadrillion nominal value in derivatives. So there's so much misallocation capital in worthless assets that we're pretending are decent or worth something, like these zombie corporations that have to borrow money to pay the dividends on their bonds. It's ridiculous. So there's a lot of slush in the market, meaning mispriced assets that make on paper or book value look good. I should say book value on paper have a certain value that really is absolutely worthless. And once that gets wringed out of the system, then we know what we really have and we can build back. But the idea that we can just switch over and keep going with the new CBDC easily, I think, is a fallacy. I think there'll be a lot of resistance, and there has to be an accounting of the reality of the physical economy and the financial markets. And right now they're far apart. The stock market no way reflects the actual true physical economy that continues to contract while the numbers on the S&P 500 continue to increase.